morning, everyone, and thank you so much firstly to Taco Media for facilitating this discussion of a topic that is very close to my heart. Thank you for everyone joining to help with this discussion. Tabile, Ron, and myself have had a chat about this, and we're really very keen for this to be an interactive session. So please put up your hand if you have any specific questions, or pose questions in the chat box or in the question box, and we will take them as they come along. Just a minute, please. I'm sorry about that. My apologies. So my name is Tarina Vlok. I am the Managing Director of Elite Risk Acceptances, a wholly owned subsidiary of Old Mutual Insure. We specialize in the non-life insurance of high net worth individuals. Tabile Nyaba is the chair of the Elite Board, Old Mutual Insure's Chief Risk Officer, and president of the Institute of Risk Managers of South Africa. And to add to that, she's an all-round fantabulous person. Ronald Richmond is the chief actuary of Old Mutual Insure, and those guys usually scare me. But he's a very, besides the fact that he's one of the most clever people I've ever had the privilege of meeting in my life, he's just a nice guy as well. Thanks, Tabs and Ron, for joining us and having this discussion on the topic that I think is very, very important for us to delve into this one. So if we could ask you to put up the first poll, please, Alex. What do you consider the top 3 risks facing insurers in 2023? So if you don't mind voting now, and let's see what the audience thinks are our main challenges. All right. Okay, I think we can take down the question and wait for the results. Just give us a couple of seconds and then we can get, yeah, Ron, right up your alley, right? Right up your alley. So the first 4 years of the decade beginning in 2020 have certainly been a very disruptive period, especially when you consider the impact of what happened in this period on the non-life insurance industry. 2020 saw the implementation of lockdowns worldwide in response to the COVID-19 pandemic. And this had devastating effects on the economy, on imports, on individuals, on businesses. And of course, this translated into unprecedented business interruption payouts by insurers. The war in the Ukraine started in Feb 2021, and it had a severe impact on costs of imports, especially on certain foods. This, combined with extremely stringent and extended lockdown periods in China, helped escalate inflation to levels way outside the Reserve Bank's target levels. These, amongst other factors, contributed largely to the current cost of living crisis we're all facing, and insurers are feeling it in the rising average cost of claims, especially on motor claims, where we've seen escalations of for a couple of years now, we've seen increases of between 15 and 25%. And then, of course, July 2021, the KZN riots caused untold damage to properties and infrastructure, whether they were insured or not insured. This incident cost Sasria well in excess of 32 billion rand. With an unemployment rate of 32.9%, analysts are considering politically fueled riots in South Africa actually as a systemic risk. Unemployment not only drives geopolitical instability, but also contributes to increased crime. Breakdown in society caused by various factors, historical and new, have led to increased crime events, with syndicates operating at ever-increasing levels of sophistication. And who's the one who has to pick up the price for all of this? Insurers. And this can be evidenced by amongst a lot of other things, but also the spate of theft and hijacking of certain high-end vehicles we've seen lately. We barely recovered from the shock of BI and July 2021 riots when we faced the devastating KZN floods of April-May 2022. Although the biggest by far, this event was certainly not isolated. Our data suggests that annual catastrophe claims between 2012 and 2022 were 10 times higher than between 2000 and 2011. We can certainly attribute many of the flood-related claims to an extended period of the La Niña phenomenon. But we know that it is always followed by the El Nino period, which is evident with the extremely high temperatures that we see in the Northern Hemisphere this summer. So whereas extended periods of heavy rainfall bring water and flood risks, dry periods with high temperatures have their own risks. Who remembers the Knysna fires of 2017? The COVID-19 pandemic also brought with it astronomical advances in digital capabilities, combined with the work from home or hybrid working models. This introduced new and increasing cyber risks, which insurers had to respond to. And then, of course, who can talk about risks in the South African insurance industry without referring to failing infrastructure, and specifically the demise of Eskom, and with it the associated risks of grid failure and the matter of load shedding with its varied levels. We've seen a significant increase in power surge-related claims following load shedding. As the audience is probably aware, most insurers have responded with conditions, limitations, and excesses to these type of claims, but that's not all. Many individuals and businesses are implementing backup power systems, which can be in the form of generators or inverters with battery storage and or solar panels. And this brings new risks. And these are brand new risks which we don't necessarily have the data for. Many suppliers, for example, are jumping at the opportunity provided by the increased demand for solar installations, without always obtaining all the credentials and accreditations. And this can lead to an increased fire risk due to non-compliant installation and specifically wiring. The high demand for solar panels also led to an increase in the theft of these panels. And again, these are all costs that have to be picked up by insurers. So I was thinking, when I put together all of these, and we're not even talking about risks that remain always front of mind when it comes to insurers, like regulation or skills scarcity. We're just talking about new risks. And I'm thinking, when you add all of these into a cauldron of risks, to me, the one thing that stands out is reinsurance. You are certainly aware that reinsurance is the insurance that insurers buy to reduce our exposure to large and accumulating losses. So for many, many years, South Africa was considered a low-risk area for catastrophes. But between KZN, load shedding, the possibility of grid failure, increased cyber exposures, this is just to name a few, these all work together in contributing to much tougher renewal terms and much higher premiums. So these cost increases almost necessarily have to be passed on to the consumer. And this in an economic environment where consumers are feeling the pinch of the increased cost of living. So how do insurers respond to this scary mixture of risks and issues that we face on a daily basis? Tabile, what are the top risks for South Africa as identified by IRMSA, and what is the impact of these risks for the insurance industry?
Thank you so much, Tarina, and great rising to each and every one of you that is on the call. Happy Monday and the rest of the week. So Tarina, you actually have touched on quite a lot that has been said or identified by IRMSA. Maybe just to share, the IRMSA has just prepared the IRMSA SA report for 2023. You just let me know if you guys are able to see what is on my screen.
We can see, thanks, Tabs.
Perfecto. All right. Yeah, so I mean, the biggest view of IRMSA really is that we are, as a country, we are facing polycrisis. Others are even calling it permacrisis, because it impacts both our macro and the microeconomic. And what we're actually seeing is that the risks are so intertwined and they're so interconnected. And then they are increasing in the severity and the frequency as well. And they occur at the same time. And that is why then we believe that we are actually facing the polycrisis. So if you just look at the top 10, that is what I have on the screen, is South Africa, the big conversations whether South Africa is actually a failed state or it is a failing state that has now degenerating into the mafia state. So that is the first one, to say that as the country, are we a failing state or are we a failed state? And that, I mean, all these other risks that we've got there, they link into the top one. So other risks that you've identified, you've already mentioned, it's the increasing unemployment and the livelihood crisis. So what we always say is that, the issue of unemployment is no longer a government issue, for instance. Us, even in the insurance industry, if unemployment is increasing, who is then going to be our customers? Who's going to be our future customers? And the third one is the failure of the public infrastructure. It goes without saying that we're talking about the water, the electricity, which is linked to the last risk of the potential grid failure. But also it talks about, the infrastructure, the things like the roads, for instance. We know the potholes and things that actually impact us as the insurance industry. Economic collapse, I need not say much about that, slow or next to zero growth in our economy. The disruption in the digitally enabled services. So what you're talking about there is our inability as a country to build the secure, resilient and reliable digital services that could result in a lot of big scales. Climate change and climate action failure, exactly what we, that's what the poll indicated to be the top risk for our industry. It is also definitely a top risk for the country. Geopolitical instability, I mean, as it is now, firstly, there was a grey listing that occurred beginning of the year, but now there is this thing that is hanging over us, the potential sanctions. They call it secondary sanctions potentially that could be that's still hanging over us, and then obviously that is informed by a lot of the relationships or our neutral stand when it comes to the Russia and the Ukraine war. The next one, it talks about, the fraud and corruption that we continuously face in the country. We know about the different reports that have been identified and being tabled, but really there's no consequence management. And obviously, and the fact that we are still currently sitting in the task force list, from the grey listing perspective. Social security, we know that there's quite an increasing reliance and the number of people that continuously rely on the social security by the government. And then the question is that, are we really going to be able to sustain that? And then the last one, we've already spoken about it, it's the national grid failure. So what we've done in here is that, all the ones that have got those little triangles, we are saying these are the risks that I believe that they impact the industry in the big way. And that is why then we also say, I've included the poly crisis there to kind of like indicate that, all these things, they intertwine, they integrate, they're interdependent. So if they happen, which is what we are seeing now, happening at the same time, pushing beyond just the boundaries and pushing beyond, it's no longer like a South African issue, it's a global issue, it's national, it's the entity itself, organization, the industry, the country, the region, the province, the continent, and even globally. So we are really seeing this, our risks being intertwined. So what I want to highlight here, Terina, is that all of these risks, one element that we hardly ever look at is the impact of all of these risks on human beings, on us as citizens, us as employees. There's a report that I read. It's a mental state of the world report. South Africa was ranked the last in that report with regards to the mental state. So we then saying all of these things have got a huge impact on us as people. And then obviously the question is that at what point are we going to reach the breaking point? So, which is why then I'm just going to continue then, Tarina, which is why then I really believe that we need to pause and remind ourselves that, guys, the risks and all these threats, or rather maybe let's just stick to the risk, has got, I call it the three sides of a coin. So just like a coin has got a head and tail, there is this middle, the middle part, which I call resilience. So now the risk is about the threat, it's about the opportunity, but it's also about the resilience. It's inevitable that we're going to continuously face these challenges. We're going to continuously face these disruptions and this crisis. But then we just need to think differently and act differently in order for us, to be able to survive and push through. The biggest observation that I have seen is that all these crises and the disruptions, they are actually not new at all. They're just repeating themselves. Like I said, it's just the magnitude of them. For instance, I think I've pulled it up. Yeah. So let's take the floods, for instance. In floods, we've had them they were North and South Carolina, the Mississippi floods, you'll remember of the 1927. And if we bring it closer to home, you'd remember that in KZN in September 1987, they were the deadliest floods that we have faced, as the country. So we've had these things. If you look at the wildfires, you'll remember the California wildfires and the Australian wildfires in 2006, 2007. And if you bring it closer to home, the Knysna fires of 2017 as well. Load shedding that we are facing currently, it started late 2007 and went all the way up until 2008. Financial crisis, we're talking about all these, the cost of living as it has been identified. All these things, financial crisis, they happened in 2008. So really what I'm saying here is that between the fact that they're going to continue happening and the fact that these things have happened already, then I think the biggest opportunity here is for us to learn the lessons from the previous experiences. We've got the playbook of the scenarios already. We just need to leverage the progress that have been made, and we need to benchmark with those that have navigated or that have gone through that and start to plug it back in here. I then also believe that victory comes from finding opportunities in problems. So we need to seize the opportunities because they're multiple. I actually believe that limitless opportunities that just lie beneath the surface of the poly crisis that we are facing. Let me give you a typical example of what I'm talking about. Take, for instance, the power outages in South Africa. They accelerated our transition to green energy. We now have got the booming solar installation, and we've got an emergence of innovation, and we've got the new platforms of the in-demand tech skills. We've got the new SMEs that are now becoming the cornerstone, not only now becoming cornerstone, but they are coming in and they remain to be the cornerstone of our economy, and they contribute significantly into our GDP growth and job creation. So it was about, okay, we're facing the power shortages, but what opportunities can we get from that? And then it's this acceleration into the green energy. Unemployment also is a risk. We know young people are also now starting not to only wish to go through the what you call the mainstream of employment, being employed by the likes of the Old Mutual and the likes of the elite, but they're starting to create their own entities, and by so doing, they're bringing in so many people, to employ them. They're creating their own little economy. Yes, sometimes it might be an informal economy, but it's still an economy. It's still solving some of the challenges that we are actually facing. So lastly, maybe then before I hand back to you, I just want to my point of this, the threats and the opportunities and the resilience, and with zooming into the opportunities. Let's look at our own big risks that we are facing as an industry. The first one was definitely the climate change, which I totally agree on. I will be approaching it from the sustainability perspective. I've got Ron, my half there. He will be talking from the actuarial side of things. But I want to use that as a typical example. As an insurance industry, we have been able to navigate through these unprecedented times, of all these things: COVID, the floods, high inflation, power outages, you name it. But the way that you've been doing it, it's around maybe de-risking, exclusions, increasing the prices. My view is that is not completely sustainable. We've got so much technology. We are in the era of the digital space. We can use the technology to help us. I know maybe Ron is going to talk about it, what we're doing from the flood perspective. So if we de-risk and exclude, I believe that yes, we are protecting our margins, current margins, but we are potentially losing the future revenue. So my take or my challenge to the industry is it not then possible for us to collaborate? Because the biggest thing is around collaboration. Shouldn't we then collaborate to actually come up with all these innovative ways? The one that I speak about in every platform where I can possibly talk about, it's what it's called the sponge cities. So, when we do that, we're not only kind of like dealing with the here and now, but we're actually solving the future problems now. The reason why I just love the sponge cities so much, Tarina, it is because, maybe just to give a bit of a background as to what these sponge cities are, but it's an infrastructure that minimizes the flood impact. So when it's flooding, there is the infrastructure. It actually sucks the water, and some of evaporate. The other amount of water gets retained so that it can be reused as well. So you see that those such things, they could be expensive. That's what I'm realizing. They could be expensive, but they will be able to solve the El Nino and the La Nina, because the sponge cities are very much resilient to the droughts. So we know now that you're moving from the wet, from the floods into the dry season. So let us look at what can we include, what can we put, how can we collaborate as an industry to put in this infrastructure that minimizes. It's definitely never going to get rid of the floods. It doesn't mean that, but it minimizes the impact of the floods. But also, we're actually saving the lives of people. We're saving the property, but we're also solving the water problem. So those are some of the things and the opportunities that I'm saying we just need to think a little bit differently. And we need to think like more sustainable. What can we do? How can we solve the problems, for the future? How can we create the future that we'd love to look at? Which is why then I'm saying I'm coming through from the sustainability angle. The other biggest opportunity really it's around the collaboration with the likes of the insurtechs. I'm not going to go much in details into that, but they will be bringing in the technology and the innovation, to us as the big insurers, maybe while they are actually benefiting, from our insurers distribution and their underwriting expertise. So all in all, I'm saying the opportunities lie. There's just limitless opportunities if we can change the way we think, change the way that we're doing things. Let us collaborate. Let us look for solutions that are sustainable than maybe looking for the solutions that are just going to cover us at the here and now. Although it looks like it's doom and gloom, but I still and strongly believe that there's so many opportunities that still lie ahead.
I must say, I'm so grateful that you talked about, you moved on to the opportunities, because that after that first slide of yours, I was properly depressed. But fortunately, I know that you see risk as a multifaceted thing, which also presents opportunities. I remember in May, I attended a conference where a very well-known British journalist was talking, and he clearly got a brief to say something positive about South Africa. And it was very, very difficult for him to find something. But the one thing that stood out, he said, you are resilient as a people. How many of you have a load shedding app? And everybody in the and those are small little opportunities, that like you said, and there are lots more of those. Thanks, Tabile. So can we just bring up the second poll question, please, to say, how do you believe insurers should respond to the opportunities presented by these risks? Okay, thank you. There aren't that many options, so I think that's enough. Can we see the results, please? I'm very keen to see. Oh, most of the audience agrees with you, Tabile, that we should leverage technology as an enabler. Thanks a lot, guys. Yeah, so these literally stormy times that we are finding ourselves in, obviously necessitated insurers to do something because we obviously still have a mandate to operate a profitable business. So from a product and underwriting perspective, we put in place several measures to mitigate most of these risks. One of the most talked about, of course, is the grid interruption or grid failure exclusion that every insurer brought in, and that was because of the exclusion on the treaties. Cyber losses, we excluded cyber losses, again, a treaty exclusion. Then insurers started responding to load shedding losses by implementing various mitigating measures, which include conditions, limits, excesses, pricing interventions. And in response to the increased theft of certain motor vehicles, most insurers started insisting on early warning tracking devices in high-risk vehicles, no matter what the value. But the one thing that keeps boggling my mind or keeps bothering me is surely we can't just price against natural disasters, because that will mean that certain areas are just becoming inaffordable. So Ron, how do you, from an actuarial perspective, mitigate the increased risks brought about by changing weather patterns?
So Tarina, thank you for that opportunity to discuss. What I think the classic answer that you're going to get from actuaries is often going to be, we need to learn more, we need to do more analysis and more analytics. What I'd like very much to share with you today are some of the analytics we're performing at Old Mutual Insure. So I'm going to share my screen and just talk you through some of the ways that Old Mutual Insure as a company is navigating climate change. And through this, I hope we'll be able to trigger some interesting questions with our audience and panel, but also really lead to a greater understanding of what are we seeing, what are we trying to do to understand climate change better, and then at the end we can discuss, well, what can we do to offer new products and not just price for this risk. So I think what we've been mentioning is that there's been an increasing frequency of and severity of natural disasters globally. So this is United States natural disasters. You can see the number in green and the cost in terms of your average cost per year in pink. You can just see this exponential trend from the 80s up to the 2010s, and you can see the last 3 years, the last 5 years have been particularly damaging from a natural catastrophe perspective. Let's have a look in the South African picture, and this is actually from Old Mutual Insure's proprietary pricing data. And here you can see that we're tracking small, medium, and large climate events. And this last decade, from 2012 to 2022, you can see this dramatic jump in all of these different types of events, but particularly the large events, which we define internally as events with more than 100 million rand impact. And while there's some debate in the popular press about is climate change driven by people, I think the scientific viewpoint is that a lot of this is driven by people's impact on the planet. And as insurers, we're not so worried about the cause. We are really just worried about how we're going to deal with this environment of significant natural catastrophes, and how we're going to keep offering our products to the public in a way that they affordable, cover the risks that the public needs, and we can do that in a way that promotes financial stability. So what I want to just show is what is the severity, in other words, what is the cost of weather-related claims from Old Mutual Insure's pricing data in the last decade. And you can see our average annual weather cat claims was 371 million rand a year in the years 2012 to 2022, but only 39 million rand in the years 2000 to 2011. And I think Tarina mentioned the statistic before that this has now increased tenfold compared to what we had in prior years. So this issue of climate change that our audience today has ranked as among the top risks that insurers face, we feel that on a almost daily basis in the insurance industry. We've also had a question. I saw in the Q&A that someone was kindly asking us about reinsurance and how do we as non-life insurers use reinsurance. Reinsurance is a key tool for us, but the reinsurers themselves have been subjected to significant losses arising out of South Africa. We've touched on Sasria claims from the July unrest. We've touched on the KZN floods. And we've also touched on COVID in just the course of this presentation this morning. And all of these claims are in the billions, above 10 billion rand each. And this is making it increasingly difficult to get reinsurers to provide the cover that you want. And if you think about a non-life insurer, one of our main inputs, if we were a chocolate factory, that would be cocoa beans and cocoa butter. As a non-life insurer, our main input is actually reinsurance. So our main supply of risk capacity has started to become more sparse and constrained than what we used to. So let's think about what we're doing in terms of understanding the various climate risks that the non-life insurance industry is exposed to. And what I just want to talk to is the two main categories of risk that we always think about. One is physical risk. This is the risk of increased damage and losses from physical phenomena associated with climate trends. So if you think about the fact that South Africa is forecast in some parts of the country to become drier as a result of climate change and hotter, that means that we'll probably be more exposed to wildfires. And unfortunately, that greater exposure is projected to be in the Western Cape. That's a good example of physical risks. The other big category of risk that we're exposed to as a large corporate entity are transitional risks. Transitional risks are the risks that arise from the fact that the world as we know it is changing. Investing heavily in fossil fuels, for example, is no longer viewed as ethically or ethically correct, or even correct for corporates to be heavily involved in. And all of these changes in society change how we have to invest our funds, the sort of regulatory standards we need to comply with, and impact us through new reporting obligations. Our responses to both of these are illustrated in the middle part of this slide. So what we're trying to do as Old Mutual Insure is think about what sort of new products can we offer in the market. We're very keen as a company to ensure the societal responses to climate change, for example, by ensuring renewable energy installations or electric vehicles. To do that, we need to understand what is the forward-looking view of what South Africa will look like in a climate change affected world. And what we're investing very heavily in are forward-looking analytics. And for the rest of the presentation, I'm going to spend some time showing you what do those analytics look like and how is South Africa likely to change in the next couple of years and decades ahead. We're also trying to understand the impacts of litigation and compliance issues, and this applies to us both as a large corporate, but also in our personal consumption. I think it's worth thinking about, are we contributing to a greener world, or are we being part of the problem, if we can look at it that way? And we're also partnering with various different institutions across the country to understand how we can drive resilience and also take action when is necessary. I think the second most voted for response was technical expert collaboration in the second poll question. And this is something that we're very proud that we do at Old Mutual Insure, which is collaborate with meteorologists and collaborate with other climate scientists in order to understand what climate risk can do for us. What I would like to discuss is just our two high-level approaches to understanding physical risks at Old Mutual Insure. So just as a reminder, physical risks are those risks that are driven by climate phenomena like temperature and rainfall. And we have two views on this. One is called the macro view, where we take a big picture view across South Africa and run catastrophe models, which shock the Old Mutual Insure insurance portfolio. And what we try to do is modify those catastrophe models to take climate change into account. We also are now taking a micro view, and the micro view is enabled by a lot of the modern advances in machine learning and artificial intelligence that you may have heard about. What we do in the micro view is we take our very granular and detailed climate information that's now becoming available to us from satellites, link that with our insurance experience, and try and understand how do climate-related effects impact our insurance portfolio. And we'll also show you some very interesting views of that in just a minute. So let's start off with the macro view, which is this view, what's happening across South Africa. And what I'd like to introduce to you is one of the main tools that we use in the non-life industry, which is something called catastrophe modeling. Catastrophe modeling is the science of making probabilistic predictions of risk due to natural and non-natural catastrophic events. So that's a bit of a mouthful. How do we do this is exactly what we're going to be discussing in the next couple of slides. Our basic goal of using catastrophe models is to predict losses to property from major catastrophic events. And this can be both natural events like earthquakes, hailstorms, floods, but also unnatural events like terrorism or riots. And what we're trying to answer with these models, as we understand the evolving risk landscape, is where can future events occur? How big can these events be? How often do we expect them to occur? And then once they do occur, what's the potential damage and insured loss that we might encounter? So as you can imagine, this is one of our main tools for understanding and navigating the sorts of risks that we have in a modern environment. So why do we do this? Well, the reason we do this is once we know how likely and how severe potential future catastrophes can be, we can start to prepare for the impact of these catastrophes. One way, for example, that we do that is we work out what's the average cost flood in South Africa, and we make sure that not only do we collect enough premiums to cover this risk, but that we also have enough capital available to stay solvent and able to meet all of our policyholders' financial demands on us if one of these events occur. Just looking at the types of risks that we model: hurricane, flood, earthquake, hail, wildfire, and winter storms. In the last 2 years, the only one that I can't think of us having had a significant one is really hurricane. We had a blizzard in South Africa, a blizzard in Johannesburg about 2 months ago. Floods, the KZN floods. We've had a significant or relatively significant earthquake event in Johannesburg. Hail is something that hasn't affected the market as much recently, and wildfire, thinking back to Knysna. So from all of these perspectives, I think we've experienced a lot of these types of risks. Let's now talk a little bit about climate change risks. How do these relate to the sorts of catastrophes that we've been discussing? So climate change creates changes both in how often or how predictable these sorts of events are, but also how extreme these events can potentially be. So let's talk through some of those. If we think about rainfall patterns changing, we've had 3 very wet years due to the La Nina event, which was mentioned by Tarina before. But as the rainfall patterns change on the longer term, that could lead to more droughts and also making it harder to predict flood events. It also leads to changes in storm activities and may expose us to much more extreme storms on the eastern coast of South Africa. These long-term changes also mean that the environment that we inhabit is going to change. Something that's been happening, and it's quite remarkable in the United Kingdom, is they've had these very, very hot summers, these heat waves during summer. And then there's a lot of subsequent subsidence claims that the insurers are getting because the ground has dried out and houses are now starting to sink and crack. And it just shows you how the risk profile of the environment we inhabit is starting to change. And then it may also give rise to very abrupt large events like tropical cyclones shifting down more towards South Africa. So as we evaluate climate change risk in South Africa, we're trying to understand how does climate change impact the frequency and severity of risks by looking at the trends in these events over time. And what we're trying to do is say, how do we take these big catastrophe simulation models we've been mentioning and start to tinker with them so that they can accurately represent what South Africa might be exposed to in the coming years. On the bottom right-hand part of the slide, we show a map of where wildfires have occurred a lot in the past. You can see the Cape on the bottom, on the southwest part of the country, but also around Gauteng, there's been quite a lot of wildfire events. And what we'd like to understand, for example, is how does our wildfire risk as a country, as a society, and as an insurer change as the climate conditions underlying wildfires start to change? So let's think about how we can actually do this. What we're showing on the right-hand part of the slide is cyclone tracks in the Mozambique Channel in the years 1969 to 2009. And you can see that only very rarely do these cyclone tracks, which are represented in green, come down south towards Durban and towards KZN. But what some climate scientists are now becoming significantly more worried about is as the oceans warm up, particularly the South Indian Ocean, that these climate patterns are going to start shifting down. And what we take into account when we model the amount of capital we need to have available to pay claims is that Durban may, for example, start getting affected more often, still a rare event, but more often than it would have by significant cyclones. What I'd like to deep dive into is flood risk, because we've just had these tremendous floods in KwaZulu-Natal. This plot in the middle, you can see South Africa highlighted there, is from the Intergovernmental Panel on Climate Change. And what they've projected is which parts of the country are likely to become wetter and which parts of the country are likely to become drier. And no surprise, in a way, that the Western Cape is projected to become drier and the Eastern Cape is projected to become wetter. But unfortunately, the risk of flood increases in terms of the number of very extreme events in both Eastern South Africa and Western South Africa. And you can see that in the plots on the left-hand part of the slide. In the plots on the right-hand part of the slide, we try to show how much capital do we think we need as an entity due to the combined effects of wetter periods in Eastern South Africa and less rain in Western South Africa. And you can see that in some of the most extreme events represented on the x-axis by the number 200, we may need almost double the amount of flood risk capital. So what does that mean for the average insurance consumer? It means make sure your insurance protects you against flood, but also start to prepare for the fact that insurers might want to understand what is your personal flood risk management. Do you have French drains protecting parts of your property? And those are the sorts of things we need to think about as people living in South Africa, that we need to also take proactive risk mitigating steps for our properties. What we're now going to talk to is a little bit of the micro modeling. So this is just a picture of one component of Old Mutual Insure's portfolio. How is it scattered over South Africa's geography? You can see in Gauteng, we've got a significant number of policies. In Cape Town, maybe our second biggest part of our portfolio, and then Durban. And this is a very common picture that you see for all insurers in South Africa. What we've now done is we've collected a very large precipitation data set with the help of experts from WITS, from the University of Pretoria, and the University in Zurich. And what we're starting to do is look at how has precipitation changed in South Africa over time. That's the blue colored plot on the left-hand part of the slide. You can see we've had some very wet years, which shouldn't surprise anybody. I sometimes feel like Johannesburg is now becoming like a rainforest during summer. And you can see how this has affected the various different provinces. The Northern Cape is often drier, but all of the provinces have experienced more rain than usual. Now, what I'd like to do just before we go to the next slide, this is going to be an animation. We're going to show on the left-hand part of the slide, what has the precipitation been over time in each province? And on the right-hand part of the slide, we're showing in red times when we've had high loss ratios. And let's just let it run a little bit. And soon what we're going to see is that when the map on the left turns very blue, indicating lots of precipitation, we often have high loss ratios indicated by red on the right-hand part of the slide. So I'm just going to let that animation run. And that gives you some idea of how we're trying to connect and relate climate experience to our portfolio. So that's very interesting, and again shows that if you're having lots of claims due to rain, it's something we need to start thinking about. Just want to show you a little bit of results. I'm not going to go into the full details of machine learning because that's not the topic of today's talk. But what we're trying to quantify is how does, for a particular policy holder, what's the chance of claim and how does that increase as the amount of precipitation in the surrounding area increase? What you can see on the graph on the right-hand part of the slide, as we move from left to right, that indicates increasing rainfall. And you can see that the probability of a claim in any particular month almost doubles from 1.5% all the way up to 2.6%. So the basic message is lots of precipitation, which, as we've said, might be affected by climate change. Lots of precipitation leads to claims. And it's something that we as an insurer help you, if you're one of our clients, to manage your risk in case something goes wrong. We also need to think about how do we proactively mitigate risks. So with all of this analytics, what's still keeping us up at night at Old Mutual Insure? One thing is that it's very difficult to disentangle the risk environment we find ourselves in, for example, it being in a La Nina precipitation cycle versus what's the longer term trend. So I think what we saw from Tabile's presentation and what Tarina indicated is we're in a changing and increasing risk environment. Is a particular flood due to climate change, due to La Nina, or just due to everything? It's also very difficult to link climate change directly to both our risk as an insurer, but also the risk that our policies out in the market represent, and building that analytics requires significant bespoke work. We had a question about reinsurance. Reinsurance, which has been very much affected by natural catastrophes in South Africa, but also globally, reinsurers have raised their prices as a result. And that means there's a global transmission mechanism. A flood in Europe suddenly starts to affect insurance prices in South Africa. And it shows how interconnected we are from a risk perspective, and then understanding the correct timescale. If climate change only unfolds over 10 to 15 years, what action should we all be taking as a society today? So just a couple of conclusions on the risk of climate change. I think climate change is going to be a topic we're going to hear more about and not less. As a company, Old Mutual Insure, and all of our subsidiaries are investigating how we can understand current and future causes of risk to our clients. We're passionate about using the latest and greatest technology to understand these risks, and hopefully our solutions can help protect you, if you're a broker, help protect your clients, and help protect all elite policyholders from volatility in times of significant change. And with that, let me hand back to Tarina.
Thanks, Ron. That's certainly a mouthful. So just help me understand, please. So you are using historical data as well as our own historical data, as well as collaboration with experts, with meteorology. What's that word?
Meteorologists.
Yeah, that one. And as well as machine learning to build predictive models for our future rating. So it is safe to say, from my understanding, that when looking at that very cool animation that you showed, that in certain areas, it is very likely that the water, the component of your rating structure will increase quite significantly.
Correct. So I think
so with the fire component.
Exactly. So what insurers need to do is make sure we're pricing for risk. And as we start to understand that risk in certain areas is increasing, so too we'll need to change our pricing structures. But I think what's really, really important is that we also need to take into account what risk mitigation exists in each area. Has the local government kept stormwater drains or fire breaks serviced and performing the correct thing that they're meant to do? Have policyholders installed flood mitigation or ensured that their properties are clear of long grass? And all of those sorts of things will also in the future allow us to credit policyholders with taking the right risk management action. And this starts to touch very much on the themes that Tabile was talking about. How do we build resilience and understand resilience as a society, but also as people living in a climate affected world? And how do we, as an insurer, build that into our pricing models to make sure that if people are taking the right risk management steps, we're giving them full credit for that?
You took the words out of my mouth, because to me that brought it right back to your point, Tabile, of collaboration. And I know insurers are also working hard to collaborate with the municipalities about infrastructure and about the maintenance of infrastructure. And so yeah, fantastic. The one thing that I realized as well, also looking at your presentation, Ron, if you want to look for good news in this tale that can be perceived as a tale of doom and gloom, these risks aren't necessarily unique to South Africa, but we're not the worst affected by them. Climate risk is at the top of the global risk for insurance, and it affects certain other areas much worse than us. I mean, I'm thinking of the wildfires in Hawaii last week, in Canada this weekend. Those are just samples of what the risks that other countries are exposed to. You mentioned California, Australia, and even Greece a while back. I mean, our Springboks are currently traveling to go to France, And France was subject to massive political riots this year. So we find that worldwide, the polarization of communities and political instability is contributing to social political unrest. But the one thing that I've also noticed worldwide, there is in the Northern Hemisphere an old risk that's rearing its ugly head again, and that is a nuclear risk. At least we're relatively protected against that. And the cost of living crisis, elevated inflation is felt worldwide. And it is showing signs of recovery, although in South Africa it takes a little bit longer because our food needs to be, additional power generation costs to our retailers has an impact on that. But another nice word that I take from you, Tabile, is resilience. So actually, both of you mentioned it. So the one thing that I know is that our industry is resilient and that we're always looking for ways to continue to give cover, as you mentioned, Ron, to price correctly for it. And in the end, we're businesses. We need to stay profitable. From what I can see, insurance is definitely becoming more expensive as the market is hardening. But I also know that there are so many ways to improve cost efficiencies and refine your models, which can be passed on then to clients in premium savings. So, as you mentioned, Tabile, it's important to plan for and hedge against these risks, but it's also important to see the opportunities presented by them. And the inherent risk of not capitalizing on opportunities is that new and tech-driven players will be leaving us traditional insurers by the wayside. And that is something that also speaks to your point of collaboration with the tech startups and the bright young minds who bring that dimension to the table. So from my side, there's a couple of questions. Ron, I was wondering if you could maybe answer Gabriel's question about the carbon credit market in Africa. Is it possible to come up with a product that can insure trees against climate risks?
That is super interesting. I guess my answer to Gabriel is there's definitely a lot of interest in developing an African carbon credit market. When I was in Egypt last year at COP27, the Egyptian finance minister was talking very much around how Egypt is keen to spearhead that. I think understanding the risks that these credits involve, whether in terms of the underlying item that they represent, like trees, and insuring those, that's a brilliant question. And quite honestly, I think it would be quite easy to develop a parametric insurance product for those. So parametric insurance is a form of insurance where you don't submit a claims form to your insurer. If there's a certain amount of drought or a certain amount of rain, it automatically pays out. And while that's an illegal product in South Africa, to the best of my knowledge, it's something that you can offer in Kenya. So I think a parametric model for Kenya would be a wonderful thing to insure some of those carbon mitigating things like trees that are being planted.
I think it's a fascinating idea. Uludari is, I assume, also from wider in Africa, is asking whether I assume your presentation only applies to South Africa, or whether you look at the wider African continent, maybe.
Tabs, what do you think? So my view on that would be that we've tried to focus this presentation on South Africa, but at Old Mutual, we're looking at the wider risks. And interestingly, a lot of the risks that we see are quite applicable and relevant to wider African countries.
And just to add on that, Ron, actually some of the risks that we're facing have already materialized in other countries and other African countries. I mean, say if you take inflation, for instance, though Zimbabwe has been through that. Yeah, the great failure. We know that Nigeria has had, I think, about 7, if I'm not mistaken. So there's quite a lot that we're also learning, from our African, countries on how they have managed some of these risks.
Sipamandla, you asked a very, very good question. And to be honest with you, we actually spoke beforehand. Shall we talk about the human risk or shall we not? And because of the topic, we decided to stick to emerging and changing risks. And this is a risk that has been on the cards for a long time, and that's the skill scarcity in the South African, not only the South African, but the worldwide in the insurance industry. Ron, especially with the power of data and analytics, which is going to drive the future. You want to speak about the scarcity of actuarial risks and data analytics, please?
Absolutely. So something that I think we feel very much in South Africa is there's not enough people overall, but there's a huge shortage of diverse people choosing short-term insurance as a career path. And this impacts the industry because there's not enough capacity to build these heavily data-intensive models. There's not enough capacity to really deep dive into some of the things we would like to do. So the industry as a whole has got some initiatives. Old Mutual Insure is very proud to have partnered with the Association of Black South African Actuaries, where we offer a lot of events and material to try attract people to the short-term insurance industry, just because it's such a fascinating place. But this is something we need to do more of, and without people either underwriting policies or managing these big fancy models, it's very difficult to operate effectively in the current risk environment. And Tabile, I don't know if you want to comment on the same from a risk perspective.
Yeah, thanks, Ronya. If I look at Spamandla's question, I genuinely believe there will always be the role of us as humans, even in the digital era, always will be. I actually see technology helping us to take away, some. I mean, if I just look at the risk management specifically, just take away, the mundane work, so that you can free up, like people to do some of the very, the thought leadership stuff, the critical stuff. So I just see us, like humans and the machines working very much intertwined for the betterment. So, but I don't see them completely replacing humans. I'm not on that one, but I just see it working in collaboration and jointly.
Absolutely. I couldn't agree more with you. Ron, I think the next question is for you. I think I could answer it, but you can. Do you have an internal climate modeling team, or do you work with external expertise? And what weather data are you currently using?
So I think that's a wonderful question. We have a small internal team because our commitment to dealing with climate risk is very high. It's not just modeling. We have a risk component to it as well. And there's a great collaboration happening in both between the actuarial and the risk teams at Old Mutual, where we're doing a lot of internal work. We collaborate externally with universities and with leaders in the space globally. And we use a lot of satellite data. So I'm not going to go into the specifics here, but the person asking the question is welcome to give me a shout, and we can share some of the technical specifics on the sort of data.
Then Edward wants to know, given the competitive nature of short-term insurance, are we looking at enhancing our product to ensure that cost versus value for money, we remain relevant? It is a fine balance, Edwin, and I would imagine you specifically refer to Elite. So Elite also had to respond to these emerging risks, and because we operate in in a target segment that is highly desirable. There's a lot of competition, and unfortunately, the competition is on price, and that's how you compete, unfortunately, in this industry. So we are constantly looking, and our board is keeping us honest on that, constantly looking at ways to enhance our product to respond to risks, so that we don't only have to rely on pricing. So it is a fine balance, and always have to keep in mind what competitors are doing. I hope that answers your question. Don't know if you would like to add something to that. And then Mduduzi is asking, how do you think about environmental catastrophes in turn triggering downstream social unrest events and exacerbating claims? Tabile, I think that maybe speaks to your area of expertise.
Yes, thanks, Mduduzi. A very, very interesting question. So the big thing that we are really observing, like I've mentioned, it's this interconnectedness of all these risks or all these disruptions. You know, if I can put it that way. So what you would genuinely think, or what you'd ordinarily think it will not trigger another, it actually does. So indeed, you know, whatever that is happening currently from the environmental side of things, it's got an impact, you know, like, I mean, let's take the floods, for instance. Okay, the floods, they result into some of the infrastructure failure because of the roads and the houses, you name it. And then obviously the disruption of the water and the energy supply and all those things, which could then ultimately result, you know, in the social unrest and, you know, for the lack of service delivery. So definitely we're seeing these things actually pulling all together and actually touching on each other, which is why then even when we address these risks, we need to address them in the most collaborated manner. We need to make sure that it does not just solve one problem, but we have to see, I mean, what other problems is this risk giving to, and how can we solve all these together, which is why then really the biggest thing that we are seeing that we need to be looking at is collaboration, and more collaboration. So yeah, because we can never solve just one, because it hits different one. And I'm also just saying as well, I've spoken about the lessons learned. I mean, even globally, some of the countries have gone through what we've gone through. It's an opportunity for us to just pick up the lessons that they have learned. Yes, we might not have the same infrastructure as they do, but we can start to have the conversations with them so that we can plug and play, you know, or rather take some of the things that work there and then implement. And lastly, we ought to be working in the preventative space. I also think that we're more reactive. You know, we wait for things to happen and then we react. I believe there's a massive opportunity for us to actually start to play in the preventative space. Some of those things could be a little bit costly, but it's better. Prevention is better than cure. That is just my belief. And obviously, I always believe that, you know, when nothing is certain, anything is possible, basically.
Awesome, thank you. Now, Ron, finally, because I don't see any more questions, I just see one from Eddie. Now, we know the old principle of insurance, where the contributions of the many pay for the losses by the few, but this has moved to a more individual risk-rated methodology. So Eddie wants to know, he says underwriting each and every risk individually is the only way to get balance on premiums, which I agree with. Why do insurers not adopt the medical aid model, an annual increase and then, if required, additional increases per risk?
I think it's such an interesting question from Eddie, because it really challenges the way that insurers operate across the world. I'll give you my intuitive answers why this won't work in non-life insurance. In medical and health insurance, your risk profile is quite clear. So in other words, your range of risks in any particular risk pool, once you differentiate by age and gender, settles down quite a lot, and your riskiest risk and your least risky risks, those buckets are much smaller compared to the main population. Whereas in non-life insurance, there are a much wider range of risks. So a young driver driving a very powerful car who happens to be male will have a very different risk profile from a young female driver driving a less powerful car who happens to be married. And those risk profiles are so incompatible that if you start to pool, what you find is that it acts more as a tax on certain members of the risk pool. And that will become very efficient from a societal perspective. I think that's why in South Africa and most countries, non-life insurance is generally not highly regulated in the same way that medical aid schemes are, and pricing is really left up to the insurer. I think it's also very interesting to look at what happens when regulators take control of pricing and don't allow for this risk differentiation. So what we've seen in the last 3 or 4 months in the United States is that in California, which is very exposed to wildfires, and Florida, which is very exposed to hurricanes, where regulators have not allowed insurers to price for the risk, a lot of insurers have just shut shop and said, well, we're no longer insuring in California and Florida. And what that really means is it's no longer financially viable to offer products at the wrong price. And I think that's what I think non-life insurers would get if we started to have pooling like medical aids do. It just doesn't work from a risk profile perspective. I think that being said, where I feel the South African insurance landscape is a bit lacking is we don't yet have a plan for people who can't get cover. So let's say you are very, very risky as assessed by insurers' financial models or pricing models. There's no government offered alternative. And that's where the United States and Europe is ahead of South Africa, is that there is a government pool. And I think offering that sort of pool, particularly in the context of climate change, really makes a lot of sense if we think about could certain areas like KZN start to become uninsurable. And I think that's where we need to start having conversations with the government and with wider society to say, we don't want anyone to get left behind. How do we make sure everyone can have cover at least some sort of financially sensible price?
Thank you very much. I don't see any further questions. There's nothing in the, okay. Are insurance companies allowed to include grid failure as an exclusion in terms of their terms and conditions? Ron, I'm happy to take that one.
You take it, Serena.
Yes, absolutely. As long as you are transparent about it, and as long as you follow the rules with regard to the exclusion, you need to give, if an insurer changes the contract from their side, they have to give notice to clients. So as long as it's done in the correct way, insurers are absolutely allowed to do it. And it's not, I can say from my experience that it's not an exclusion that's taken lightly. It was not once taken lightly. I said in my introduction, we had to implement the exclusion because it was excluded from our insurance treaties. There was a lot of collaboration in the industry with legal experts, with the FIA, with the reinsurers, to make sure that we word this exclusion correctly. And it was rolled out in a correct and very deliberate fashion to clients in accordance with the legal requirements. So I'm very comfortable that our grid interruption exclusion has been implemented correctly. There are certain scenarios. I get a lot of inquiries about scenarios, excuse me, that I struggle to answer. I really struggle to answer. And I know to say, excuse me, guys, I know to say each claim will be assessed on its own merit is can sound vague, but unfortunately it's true. So I had a question this morning, for example, if grid interruption caused the alarm to not work, and the alarm to not work, and there's a break-in, would the exclusion apply, or would the insurer honor the claim? And it was literally impossible for me to respond to the question because I didn't have all the circumstances of the scenario. So it is difficult. Let's just hope it doesn't ever happen. According to many analysts, the likelihood of grid failure is extremely low. And that is why we have load shedding. So, okay. Is that a question, or are you just making a statement? Anyway, a certain direct insurer won't ever turn insurance away. We see it. We see poorly performing clients leaving us to go elsewhere. But anyway, thank you for that. Thank you very much, everyone. Thank you, everyone, for attending. Thank you so much, Ron Tabile, for joining me in this. Thank you very much to Topco for giving us this platform. And I think that concludes this session. Thank you very much. I saw there's a question whether we can make the slides available. Can we? All right. Thank you.
We can discuss.
All right, we can discuss. It's proprietary information. Right. Thank you. Bye-bye.